Welcome. Let's take a look at segmented income statements. And to do so, if you'll just turn to that problem in your lecture notes, we'll get started. Java Inc. produces coffee makers and espresso machines. During the past year, the company produced and sold 40,000 coffee makers and 20,000 espresso machines. Fixed costs for Java totaled $800,000, of which $400,000 can be avoided if coffee makers are not produced, and $250,000 of which can be avoided if espresso machines are not produced. So you can see that I have this part of the problem highlighted. We need to make sure we understand what this means. Fixed cost for producing both products is $800,000. But when they tell us that of this amount, $400,000 can be avoided if coffee makers are not produced, that's another way of telling us that there's $400,000 of direct fixed costs associated with the coffee makers. Likewise, $250,000 can be avoided if espresso machines are not produced, and so these are direct fixed costs associated with espresso machines. Revenue and variable cost information follow. Variable production costs for coffee makers are $20 per unit, espresso machines $40 per unit. Selling prices are $50 and $90 respectively. In addition, a 10% sales commission is paid for each product line. Calculate the segment margin for each product line. So when we prepare segmented income statements, we'll create a column for each of them, and then we may want to also have a total company column. Also, we'll start with the contribution margin format, meaning we'll take sales minus variable costs. And in the problem, you saw that there were two variable cost types. Variable production costs would mean variable cost of goods sold would need to be determined. And then there was a sales commission, and so that's our variable selling expense. So sales minus variable cost is equal to contribution margin. We then subtract fixed costs, but when we do segmented income statements, remember we have to identify for fixed costs which ones are direct and which ones are indirect or common. First, we subtract the direct fixed costs. This will give us our segment margin, and this is the number used by management to evaluate each of these segments. Then we subtract common fixed costs, and we will have net operating income. Now, to make these calculations, if you'll look back at your information, you'll see that the selling price is $50 for coffee makers, and we expect to sell 40,000. And espresso machines $90 per unit and sales of 20,000. So when we calculate sales for coffee makers, you can see the computation or the supporting computations down there toward the bottom of the screen. Coffee makers 40,000 units times $50, that's 2 million. Espresso machines 20,000 units at $90, that's 1.8 million. So total company sales are $3,800,000. All right, so once again, refer to your information. The variable production cost for coffee makers is 20 per unit and espresso machines is 40. So our cost of goods sold calculations look like this. 40,000 units of coffee makers at $20 of variable production costs. That's $800,000 of cost of goods sold. 20,000 espresso machines at a cost of 40 says variable cost of goods sold for espresso machines will also be $800,000. Total variable cost of goods sold will be $1,600,000. The sales commissions are 10% of sales. So to calculate that amount for each of the segments, for coffee makers, 10% of sales, or 2 million, is 200,000. 10% of 1.8 million is 180,000. So total variable selling expense is $380,000. From here, we'll do our math, and we can see that coffee makers will have a contribution margin of $1 million. Espresso machines, $820,000, for a total of $1,820,000. Remember that we were told that $400,000 of fixed costs would not exist if coffee makers did not exist. So this means that those are directly associated with coffee makers, because by definition, a direct fixed cost exists because the segment exists. If you stop making espresso machines, you would save the $250,000 of direct fixed cost. So the direct fixed cost totals $650,000. Now we can compute our segment margin. $1 million minus $400,000 is $600,000. Espresso machines segment margin is $570,000. And the total company, $1,170,000. Now, if we're asked to total out the net operating income for the company, we're going to have to find what our common fixed costs are. Refer back to your information, and you'll find that total fixed costs were given to be $800,000. Of that amount, $650,000 was directly traceable to the two segments. So from this, we can figure out that common fixed costs were $150,000. So we'll put that in the total company column. Note that this could be allocated among coffee makers and espresso machines, but it really has very little meaning. Company-wide net operating income then is $1,020,000. So you can see this is what a segmented income statement looks like. We will compute the net operating income for the entire company, but when we're trying to evaluate coffee makers and espresso machines as segments, we would want to use the segment margin. All right, that concludes this problem. So do some homework problems, bring any questions to class, and I will see you then.